Hi everyone. After primary market, we are going to talk about secondary market like I mentioned in my previous video. Primary market is a market where the securities are issued for the first time and it is also known as new issue market. Now when we talk about secondary market, it's a market where shares are issued, existing share which are already there in the market are sold and purchased. So that means share which were issued in the primary market, once a person keeps those share for some time and wants to sell them later on, goes to nowhere else but to a secondary market, that is to stock exchange. So let's read what all stock exchange and secondary market has to tell us about. It is a market for sale and purchase of existing securities, of course yes, which have already been sold for the first time. The other name for secondary market is stock exchange, that we know already. Here securities are not issued directly to the investors, so direct dealing with the investors are not there. Why? Because we are dealing in already the securities which have been sold for the first time. So whenever securities are sold for the first time, the relationship it is between company and the person who purchases the security. Now buying and selling will happen between two people. One person who wants to sell the securities, another person who wants to buy the securities. So the company is not involved. So direct capital formation for the company is not there. Of course, company does not lose any capital because securities are being traded. But then somebody else purchases it, the owner changes, that's it. Alright. So here securities are not issued directly to investors. Here existing securities are traded. They impart liquidity to the investment. Liquidity means convertibility to cash. Very easy convertibility to cash. When your securities are easy saleable in the market, that means they are liquid enough. Sometimes a share may not find a buyer, but usually they impart liquidity. Enhances marketability. Marketability means buying and selling of securities. It does not lead to direct capital formation like I told you. It helps existing investors to disinvest and new investors to enter into the market. Now, what is disinvestment and investors to enter into the market? So what happens is the person who was holding the shares on his name, he sells the shares, somebody else purchases. So somebody else comes as the person, as the owner of the share. So and this one who sells his shares of a particular company buys shares of another company. So disinvestment and reinvestment takes place in our secondary market. Next we come to the stock exchange. What are we talking about when we are talking about stock exchange? I have a definition for stock exchange out here. It's a market in which existing securities are bought and sold. It's as same as secondary market. So whenever a proper definition is asked, you will explain this definition, you will mention this definition. It is an association, an organization or body of individual, whether incorporated or not, established for the purpose of assisting, helping, regulating, making work, controlling, checking the business in buying and selling or dealing in securities. A place where securities are traded, a place where securities are controlled, a place where securities are actually regulated, a place where people come together in helping the people to buy the securities and the companies to sell their securities. Now, here dealing takes place in shares, debentures, bonds issued by private, public and government companies. Yes, we do have all the type of companies issuing shares. Even the banks nowadays, they issue their shares. So as a market, the stock exchange facilitates the exchange of security into money and vice versa. Of course, yes, the shares get converted into money and you can buy the shares with money or from money, and that's why we talked about liquidity. This is what liquidity talks about in the secondary market. Only those securities could be traded here that are included in the official list of stock exchange, because transparency is a very basic feature of stock exchange. Nowadays, initially it was not there. So you need to know the list of the companies which is there. Whichever company is doing well, you check it on the internet every time, and then you buy the shares. So you know which companies shares are available, you know which company is doing well, which shares are going high in the price, how the stock market is behaving, and according to that you buy your share. So listing of securities is very important. It does two things to the company. One, it enhances their goodwill. Second, it creates an interest in the mind of the investor to buy the particular kind of shares. Now, there are 21 regional stock exchanges and 2 we already know, BSE and NSE. We see those triangles when our news comes, rise and fall of price of shares, and we can see the name BSE, Bombay Stock Exchange, NSE, National Stock Exchange coming. It runs through the news, when your news is going on the television, this is what we are going to talk about in secondary market. So first we'll start with the functions of the stock exchange. Starting with functions of stock exchange, we start with the first thing, that is provide liquidity and marketability of existing securities. We know it very well. What stock exchange does to us is that it helps in liquidity. Liquidity means converting the shares into cash, and marketability means easy buying and selling. The main function of stock exchange is to provide ready and continuous market for sale and exchange or purchase of securities. It gives investor the chance to disinvest, sell old securities and reinvest, buy new securities of another company, providing liquidity and marketability to existing securities in the market. That's how it provides liquidity and marketability. Pricing of securities. So share price on the stock exchange actually are determined by the forces of demand and supply. The demand of particular share which is there in the market, more demand is there in the market and supply is less, prices will be determined accordingly, and vice versa. If demand is lesser and supply is more, price will be determined accordingly. Where do we check all these? We check at Bombay Stock Exchange, we check at National Stock Exchange, Nifty, Sensex. They all provide, the indices provide us with the complete information regarding the same. Stock market indices like Sensex, BSE, NSE reflect market directions and indicate day-to-day fluctuations in price. So we come to know through stock exchange, information about price movement is determined. This information is essential for buyers and sellers, undoubtedly. That's why whenever I say when you have this triangle, something like this and like this, we're talking about the price rise and price fall. Contributes to economic growth. Undoubtedly, when money is being used for productive uses, it is contributing to the economic growth of the of any country or of any economy. So when the money is the savings are getting when savings are being put into most productive uses. Our stock exchange is a market in which existing securities are bought and sold. Through this process of reinvestment and disinvestment, saving gets channeled into most productive investment use. This leads to capital formation and economic growth. If there would have been no stock exchange, there would have been low savings and low economic growth. Initially what people were doing, they were buying gold and silver, but then there was not so much of commercialization of things. People were not involved into so much of commercial activity, apart from, like, they were not into so much of market scenario. They were not buying branded things, branded clothes, so many things are there. So what they used to do was they used to buy gold and silver, and ultimately what used to happen was that gold and silver used to remain with them. There was no, that money never used to flow in the economy and never used to get back in any other way to the people. So that was a basic problem, but now it has changed. There's an economic growth, money comes to the market and people have, it is increasing their purchasing power to buy many other things. Spreading equity cult. Now, the stock exchanges can play a vital role in ensuring wider share ownership by regulating new issues, better trading practices, and taking effective steps in educating the public about investment. Like I just was talking about that initially people used to buy gold and silver, this got changed and people started buying what? Equity shares. So this spread of equity cult is all thanks to the stock exchange, undoubtedly, the share market, undoubtedly, and people started buying these and stopped investing in gold and silver to that extent what they used to do initially. Why? Because they wanted to invest into, they became most of the people, they were risk averse initially. Now they become more risk takers. They're ready to take risk and adapt to the market. So they take the risk, they invest, they get better returns and are ready to invest more in the capital market. Now, safety of transaction. The membership of stock exchange is well regulated and its dealings are well defined according to the existing legal framework. This ensures that the investing public gets a safe and fair deal on the market. Now, when you talk about safety of transaction, things are very transparent. Everything is now dematerialized. People have to open up a demat account. We are going to discuss about it in the next topic. Demat is like when you have to open up a basic account to deal on the stock exchange. Your account is password protected. So many things are there, and as well as the government has taken an initiative. They have given a regulatory body called Securities Exchange Board of India, which regulates the stock market and checks everything is being done in the interest of the investors. So comparatively the frauds have become less. They are still there, but comparatively transactions are safe and better. Continue with the functions of stock exchange. The last point is providing scope for speculation. Now, what is speculation? Speculation is when we manipulate the prices in the stock market. So this is healthy for the stock exchange because that manipulation should be there. People would buy the shares when the price of the equity is high. They would never buy the share when the price of the equity is less, or when the stock market is doing well, then only people would buy the share. So healthy speculation is good, but excessive manipulation is not a very good idea, and stock exchange provides for good and healthy speculation. Stock exchange provides sufficient scope within the provisions of law for speculative activity in restrictive and controlled manner. We don't want another Harshad Mehta happening in India. That is why legal speculative manner, legal and controlled manner speculation is good. It is generally accepted that a certain degree of healthy speculation is necessary to ensure liquidity and price continuity in the market. Just now told you, share price do actually get affected according to the speculation. The investors do get attracted because of the speculation. Now, we talked so much about stock exchange and the secondary market. If we do not talk about how actually the process happens in the secondary market, the things would be incomplete. So before talking about the process, what are we doing presently in the stock market? We are doing online trading. That is, whatever was being done through the newspapers, magazines and traditional outcry system. Now, what was the outcry system? The stock exchanges used to have people on the floor, and they were boundary at a higher level. They were boundary all the four sides, and the companies used to stand there, and the investors used to stand, the people who wanted to buy share, they used to stand there, and there used to be an outcry or a bidding system, and share prices used to be, auction, and whatever used to be the higher price, that used to be finalized as the price of the particular company's share. Changed into a very beautiful system called online trading system or screen based trading system, where everything happened or was happening through the computer terminal. People got computers and all the transactions were happening online through the screen of computers. So let's know what is electronic trading system. It means online screen based electronic trading system. The buying and selling of shares and debentures are done through a computer terminal. Computer terminal with people, all the brokers and the people who want to buy the share all deal through each other with the online system. Now, traditionally it was open outcry system. Securities were bought and sold on the floor of the stock exchange through auction system. This got changed, like I told you, to online screen based trading system. Now, what are the advantages of an electronic trading system? Starting with the advantage, the first and foremost advantage was transparency. Everything could be seen on the screen of the computer. It ensures transparency as it allows participants to see the prices of all the securities in the market while business is being transacted. So everything was screen based. Second, increases efficiency of information. Quick information. Newspapers were very late. Outcry system was very slow. So quick, easy, efficient system of getting the information. It increases efficiency of information being processed and thus helps in fixing prices effectively. The computer screen displays information on prices and also about capital market developments that influences share prices, mindset of the investors, and they immediately decide or decide not to buy the particular share. It increases the efficiency of operations. How? Working became efficient, quick, immediately. Initially, the shares were actually recorded and then they were sent through the post, and sometimes people used to receive it, sometimes not receive it. Here, it increases the efficiency of operation since there is reduction in time, cost and risk of error. Next, people from all over the country and abroad can buy and sell. Buy is not very clear out here, so I'll write it out here. Buy and sell shares. This system has enabled a large number of participants to trade with each other, thereby improving the liquidity in the market. Easy availability, convertibility into cash. It became so efficient that easy conversion of shares was taking place. Initially, sometimes shares never used to find a buyer. Now there was a market ready to equip everything, all information to the people, and buying of shares and debentures became an easy task. A single trading platform has been provided as the business is done at the same time in all trading centers. One single trading platform, all people come together at the same time, and they engross themselves in buying and selling of the shares at the same time. So one single trading platform for the buying and selling of securities was happening, and all thanks to screen based trading. So now we are starting with, like I told you, the process of trading of securities on the stock exchange. Starting with the procedure of trading on the stock exchange, we come to the first step, that is called selection of broker. Second step is opening up a demat account. Third is selection of securities and placing the order. Fourth is executing the order, and the last one is settlement. In the book, it has been given in 10 steps. I've just put few steps together, amalgamated the steps and made it a little briefer and made it little exact for you to understand. So starting with the first step of the procedure of trading on the stock exchange, we start with the selection of broker. Before starting with the selection of broker, I'll just give you a little introduction. See, what used to happen was that when we used to do trading on the stock exchange, it was initially done through the people by applying for the securities. They used to take out the prospectus. From the prospectus, they used to take out the application form, or they used to go to the broker and then take the application form, fill it up, and then attach a check along with it, which is to be deposited to the bank to get the share application accepted, and then the allotment of the shares used to be done. Now, all this used to be a very lengthy procedure. Along with that, all the securities were traded manually. The documents used to reach manually. So there was a lot of forgery and a lot of theft happening at that time. And because of that, a new concept came into existence that was called that the dematerialization of the account. That everything would be done now electronically online. So every Indian citizen who has to buy shares or sell shares on the stock exchange has to open up a demat account. We'll be doing a video on the opening or working of the demat account also later on. But right now, just a briefing about it. So I had to open up a demat account, and that demat account used to allow the person, like you have a bank account, similarly you have an account with one of the issuing house or some of the stock houses. They have that demat account, like I have a demat account in India Booth. So you open up a demat account and then you can freely buy and sell securities on the stock exchange. Of course, you need a broker to do all the things for you, but that became a little easier, and all the share certificates used to come online into your account, in your email account, and that's how the procedure started happening. So starting with the first step, selection of a broker. Now, who's a broker? Broker is an intermediary who actually helps in buying and selling of these shares. He's the one who's as a contact person for both buyers as well as sellers. Now, first step is to select a stockbroker who will buy and sell the securities on behalf of the investors, those who are interested in buying and selling of the securities, people. Trading of securities can be done only through SEBI registered stockbrokers who are members of the stock exchange. So you have to get listed with the stock exchange to be the member of the stock exchange. You have to deposit some kind of money and you have to open up an account with them, and then you become a registered broker with the stock exchange. They may be individuals, partnership firms, or corporate bodies. Brokers charge brokerage or commission for the same. Then the investor has to sign a broker-client agreement and a client registration form before placing an order. Client has to provide certain details about himself, like if I have to open up a demat account and if I have to go to a broker and if I want to buy and sell securities, so what all is required? PAN number, date of birth, address, educational qualification, occupation, residential address, that is whether I'm an Indian or NRI, non-resident Indian, bank account details, depository account details, name of any other broker, and then we need client, not code number, it is written wrong, client code number. Okay, so all these details are to be filled in. Once all these details are there, then you get registered with the broker, and once you're registered with the broker, it's easier to carry on your procedure on the stock exchange. Next is opening up a demat account with the broker. Next step is to open up demat account or beneficial owner account number, which is called BOID, BOID, with a depository participant. Now depository participant are there. Once we'll talk about depository, we'll talk about the depository participant, but just a briefing out here. Depository participant are something like bank with who you open your account number. Similarly, depository participants are there with whom you open up an account number, the demat account number, to deal on the stock exchange for buying and selling of the securities. Now this is mandatory for every Indian citizen. In the demat account, securities are held electronically. So dematerialization or demat is the same. It means holding securities in electronic form. Next is selection of securities and placing order. Investor may consult with broker and take advice for selection of securities. Now, usually brokers do advise about what kind of securities to buy on the stock exchange or to what kind of securities are to be sold. And then once we did the functions of stock exchange, we talked about disinvestment and reinvestment. So, if you want to sell off your old securities and you want to buy securities of another company, so that kind of advice is actually provided by the broker. It is important to select time for trading and also to get best advantage from buying and selling of securities. Then the investor specifies the number of securities he would like to buy or sell. So he will buy or sell either of the things. Now, the order can be communicated to the broker either personally or through telephone or cell phone or email. Only listed securities can be dealt. Why? Because these are actually the securities which are legally allowed to be traded on the stock exchange. And moreover, you have more faith in the listed securities. So these are the first 3 steps. First step was selection of broker, like we did it. Second step was opening up a demat account. And the third step, selection of securities and placing the order. So we've just done with the first, second and third step. Executing the order and settlement is next what we are going to talk about. Continue with the process. Next we come to is executing the order. That is the fourth step, like I've written. So according to the instruction of the investor, the broker buys or sells the securities. Now what is to be done? There's a contract note which has to be actually signed. So the broker issues contract note. This contains the details of the number of shares to be bought or sold to the investor. And also the broker mentions the name of the company, price of the security, that is a trade, brokerage, etc. on the contract note. Very important. And then what happens is a unique code number is issued or assigned to each transaction by stock exchange and printed on the contract note. So every transaction is a separate transaction. Last step in the process is settlement. Settlement is a process whereby payment is made by the broker who has made the purchase and share delivery by the broker who has made the sales. So both the brokers, they do the dealing of buying and selling of the shares on behalf of their investors. Now the investor has to deliver the shares sold or pay cash for the shares bought, whatever. If you have purchased the shares, you have to pay cash for it. If you have sold the shares, then you have to give the delivery of the shares. This should be done immediately after receiving the contract note. Once you receive this contract note, which has already been issued by the broker to you, and then you have your unique code number, immediately what you do is you should immediately after receiving the contract note or before the day when the broker shall make payment or delivery of shares to the exchange. So this is called pay-in day. What you have to do is the moment you receive the contract note or before making the payment or the delivery, payment is to be made by the person who buys the share and delivery of share, one who is selling the shares, that broker, to the exchange. This is called pay-in day, and you have to actually consider the pay-in day. After doing this, next what you have to do is that you have to talk about the payout day. Now this is the last stage in the trading of the securities. The settlement all depends upon the kind of contract which you have signed. You have to follow equity spot T+2 rolling settlement. T+2 is trading plus 2 days of grace. Then equity spot market follows T+2 rolling settlement. On T+2 day, the exchange will deliver the share. The shares are delivered to the person who's purchased or make payment to the other broker, that is the payout day. Whichever way, either you have purchased the share or you have sold the share, all the transaction will be completed with the payout day once the contract note has been issued and pay-in day has been winded off clearly. Now, this means that any trade taking place on Monday gets settled by Wednesday. Now, delivery of shares must be made in dematerialized form very clearly. It is no more done in the paper pen form. The broker has to make payment to the investor within 24 hours of the payout day, since he has already received the payment from the exchange. Complete transaction done on the stock exchange. So now you already have the knowledge of buying and selling of the shares. If you're 18 and above, please go ahead, open up your demat account and start trading on the securities market. You will get a clarity how shares are bought and sold on the stock exchange. Previously you could not buy one shares, but now one lot trading is allowed, so you can buy and sell one share also. Do that so that you get the access to how the trading on the stock exchange happens, and it's a very nice and very effective way of earning simple money. So we wind off with the trading of stock exchange. Next we come up to is I'll just talk about the next video about the difference between primary and secondary market and money and capital market, and after that we'll go ahead with depository and demat. Right. Coming to the difference of primary market and secondary market and money market and capital market. Why doing this in between? Doing this in between because we have finished with money market, capital market in totality. We have done primary and secondary basically. We finished off with what is the content, basic content of primary and secondary market. So once we understand the difference, then I'll explain about, then we'll talk about the rest of the topics which are like little extra also, and we need to just basically understand them. So let's come down to first difference between money market and capital market. First, on the basis of the participants. Money market participants are RBI, financial institutions, banks, corporates, whereas capital market are financial institutions, banks, corporates and foreign investors. You get a board question on this usually. This is a 1 mark question. Instrument. Here call money, commercial bill, commercial paper, certificate of deposit and treasury bill. Here we deal with share, debentures and bonds. Then next, this was also a board question. Now next, investment outlay. Huge investment outlay because treasury bills are like, for example, treasury bills are issued at 25,000 and multiples, whereas this is an outlay small comparatively because shares are issued at 10 or 100 in multiples of, these are in multiples of tens and 100. Duration. This is short term up to 1 year. This is long term and long and medium term with maturity period more than 1 year. So it could be 3 years, 5 years, 25 years. Debentures are for 20-25 years also. Shares are for lifetime. Liquidity, which is highly liquid. Money market. This was again a board question, which is highly liquid. Money market. Why? Because this Discount Finance House of India, which provides ready market for money market instruments, whereas this is considered to be liquid but comparatively less liquid. Why? Because sometimes share may not find a buyer. Why? Because the market may not be in such a the stock market or the capital market may not be in such a condition. There is depression going on. People may not buy shares. They may prefer debentures at that time. So share may not find a buyer. Then safety. Money market is safer with minimum risk or default due to shorter duration, and this is riskier with respect to returns and principles of payment. Sometimes your shares, they don't do well and the whole money gets into pits. So at that time you have to be very well prepared. Of course, we say when you want to buy the shares, that means you're ready to take risk, and if you're not ready to take risk, you buy debentures. But then sometimes the shares, and with the shares you may not get enough returns and you may not get your principal amount also back. Next we come to is expected return. Yields less return due to shorter duration. Money market has a shorter duration. This was also a board question. Here it yields a higher return due to longer duration. One, for a longer duration when money is invested you get more returns, and scope of earning capital gains in equity shares. Like on equity shares you get capital gains. Why? Because with the longer duration the value of equity share increases. Prosperity of companies shared by shareholders, of course yes, they get more dividend by way of high dividend and bonus issues. So comparatively the returns are better in the capital market. This was a difference between capital and money market. So I am writing here difference. Now difference between capital and money market. Next we come to difference between primary and secondary market. So well, first we talk about primary market. The other name for primary market is new issue market. Like I've written here, I've already told you always this is a new issue market and this is called, the other name is stock exchange. All right. When we talk about the securities traded in the primary market, there is sale of securities by new companies. So only securities are sold out here. When we talk about secondary market, the securities are traded, trading of existing securities, that is the already sold securities are bought and sold by other people. So trading takes place. In new issue market, when we talk about, it's buying and selling. So buying on the basis of buying and selling, in new issue market only buying of security takes place. We do not sell securities out here, no selling takes place. But in stock exchange, both buying and selling of securities takes place. The next, company involvement. Now again, since buying is happening, so company is selling the securities for the first time, company is involved, securities are sold by the company to the investors directly. But when we talk about stock exchange, ownership of the existing securities is exchanged between investors, the company is not involved, two people get involved with the help of broker, buying and selling of the securities takes place. Capital formation. Here capital formation is direct from savers to investors. Here indirect capital formation is there. Why? Because two investors are there. Price determination. Price of securities are determined by the management of the company. They decide whether the share is going to be for 10 rupees or in multiples of 10, whichever way it is. Prices are determined by the demand and supplies of the security. Whatever is the market value of the shares, that's what you deal in with in the secondary market. Location, here there is no fixed location, geographic location is not there, and in terms of secondary market, it is located at specific places. Like we told you, there are 21 regional stock exchanges and 2 national, that is BSE and NSE, Bombay Stock Exchange and National Stock Exchange. That's all about primary, secondary, money market, capital market. Next we will be talking about depositories and DMAT and Bombay Stock Exchange and National Stock Exchange and SEBI. Till then, bye bye.